Good morning. Okay, class, good morning. So, you're welcome to another class. So, today we have two topics to look at. First is Ifrs 13, and second is IS 36. So, last week we could not have our normal class. So, remember that we did online last week. And that online, what we basically did was to revise what we have looked at on financial instruments and also to finish up on impairment of financial assets last week, which we did online. So we are back to class today to continue with our standards. And if you remember, the entire thing about financial instruments was just all about debt instrument and equity instruments. In financial instruments, we learned about IS 32 and also IFRS 9. We learn about how to recognize and measure financial assets, financial liabilities, and also equity instruments. And specifically last week, we started with compound financial instruments, whereby a borrower used a convertible bond or a convertible loan to borrow money, and that led to a situation whereby the investor can either get his money back at maturity, either by collecting back his money or converting that his money to shares. That is a convertible bond. And we said in accounting for that, the issuer must take account of both the debt and the equity element because it has elements of the two since it is convertible to share. So at the date of the issue immediately, you need to separate whatever money he has borrowed between debt and equity. If you had revised it, what I'm saying now will make sense to you. And also, we then looked at impairment of financial assets. So for impairment of financial assets, I told you that the model that is used in impairing financial asset now is an expected credit loss model, ECL, expected credit loss model. And the whole idea of that model is that don't wait until a financial asset goes bad. Don't wait until your borrower, the person you lent money, fail to pay you before you start impairing that financial asset. So the expected credit loss model focuses on the fact that expect that there might be default. So when we are making impairment now, using expected credit loss model, we said you can either have a 1 year, like a 12-month ECL, or you have a lifetime ECL. So the 1 year ECL is look at a possibility that there can be a default event within 1 year in such a way that immediately you invest, immediately you lend someone money, you must consider that they might default. So on origination, you're already making or taking account of impairment. That's like a 12-month ECL. And there is also a lifetime ECL. For lifetime ECL, we are saying that look at the possibility of a default event happening over the lifetime of that instrument, over the lifetime of that investment. Those are the type of impairments we can make. So with those two types, we then say there are three stages of impairments. So the stage one is on origination. Immediately you invest, you need to classify that financial asset at stage one. And at that stage one, you would make a 12-month ECL. You would make a 12-month ECL. So when I'm saying 12-month ECL, we are just saying just estimate is an assumption. Estimate that there might be default. So you could estimate 1% as uncollectible. You could estimate 2%, whatever estimate you want to make. But just ensure that this your estimate is based on reasonable, supportable assumption based on your relationship with that person. So that means that you can even estimate that there won't be default. So your 12-month ECL might even be zero. depending on your history with that person. So if that person is somebody that has been paying often, it does not default. So there's no reason why you should estimate possibility of a default. So we are not saying you must say, it depends. Something like that. Okay, so at origination, you put it in level one or stage one. And at that stage one, you have a 12-month ECL. And at the end of each year, you need to reassess the loan. You need to reassess that investment and then consider that is there increase in significant credit risk? Is there increase in significant credit risk? So when we say increase in credit risk, when we say credit risk first, is a risk or possibility that there might be a default or that you might lose your money. So if credit risk increases, there is a possibility that you might lose your money. And the way you would determine that in an exam question is that they would have given you scenarios that there are tensions in the business environment or even in the internal operational activity of the person you give money to. They will give you that, they will paint that kind of scenario to you that the guy is in trouble, there is Boko Haram unrest in his country, there is issues in his state. Then you can judge from there that there is an increase in significant what? Credit risk. So when such happen, that means you will need to move that financial asset and classify it as stage two when there's increase in significant credit risk. And when that happens, you are going to have to make a lifetime ECL. That means if the determination of your ECL or impairment is based on rates, what that simply means is that the rate you are going to have to make for impairment will be higher, maybe 10% or 15% or whatever. But in the exam, of course, they want you to calculate, they will give you such a rate. But if significant credit risk has not increased, that everything is still okay, no tension in his environment, that means there's no need to start making a lifetime ECL. So you just continue to make a 12-month ECL. So, and that is how it continues like that. Every year you will reassess that asset and see that is there increase in significant credit risk? Is there no increase in significant credit risk? Because that's what will determine whether you are making a lifetime ECL or a 12-month ECL. Then if it now happens that the person defaults, that is supposed to pay on this day, he now did not pay. That is a default. When such default happens, immediately you classify such a loan or such a financial asset as stage three. And of course, at stage three, you still continue to make your lifetime ECL. The only difference is that when you are booking interest revenue or interest income on such financial asset, it will be based on the net carrying amount or on the amortized cost as against the gross, in the sense that you will have removed whatever impairment you have recognized so far from that financial asset itself before you calculate your interest on the amortized cost on the net carrying amount. So basically, these were all the things we discussed on impairment of financial assets and others, like last week, and I hope that you had revised it. So the beauty of all of these things is your ability to create time and ensure you revise them. Because if you don't revise them, you obviously forget. And it's becoming a lot now. Because as it is today, the reality is that when I take out today, I have 7 more classes with you guys. So it's gradually coming to an end. And we have done so much that I even gave you assignments, you did not do it. That shows the length of so much we have done because you haven't had time to do it. You have to create time because in the coming weeks now, I would now be, I would do like a booklet for you on all the topics and all the standards I'm going to teach you. Hopefully, I would cover a significant portion of what I want to do today because this month now, what we want to achieve this month is probably this one IS 36, IFRS 15. I don't know, I can just suddenly fall in love with IFRS 15. Almost every day now, IFRS 15. IFRS 15, IS 21, and IFRS 8, operating segments. These are short standards, but they are key. And there are some other ones that I might not teach you, depends. Like IES 24 and IES 10. Even if I might teach you, probably maybe I will teach you maybe online because they are probably theoretical standards. Okay. Definitely, definitely. The one of last night. Okay, that one is even easier, but I'll probably look at it. But by the time I've solved the one I want to solve, the one you just showed me will be very easy for us to really attack. So don't worry, we'll be covered. So that's what we want to achieve this month, those key standards. Then in October, there is a 40% part of your syllabus. They said it's 40%, right? One is ratio analysis. Back diet in, diet out. I can have been asking ratio, ratio, ratio. They didn't ask ratio. Of course, it was there. It was there. They asked ratio. So we have been expecting EPS. I know you have done EPS, right? So I've been expecting EPS, no EPS. So still prepare for EPS this diet because it could come out, but they have ratio, ratio, ratio. Before they used to alternate it, but now they are not. But we are sure that ratio or EPS, and it's always 20 marks. So it's 20% of the syllabus. And there is one other one beyond financial reporting. Last night they didn't even ask it at all. You're surprised. Yes. So they didn't ask it at all. So we had that's when we'll be doing stuff like sustainability reporting, integrated reporting, and corporate governance reports, risk reports. They didn't ask any of those things last night. So we might have a situation where we have it last night, this night. So the only one that they asked that which we did not even look at is interim reports. Interim. That was what I can brought out in section B of the exam. Okay, so we have an interesting 8 or 7 weeks to go. So let's see how well we make use of it. But we can never afford to miss any week of class. Every week is very, very important. So I'm even surprised that you could let a week go without reading what we have taught you. Because I mean, I don't know how you want to cope with that. IFRS 13. So let's see what we can do in 30 to 35 minutes. This is a very short standard. So you see, what IFRS 13 came to do, in fact, the first thing is that IFRS 13 is a joint effort between the IASB and the FASB. So the FASB is the body in charge of the United States GAAP. And over time, both bodies, both the IASB and the FASB, has been working towards harmonization of their standards. They did that for this IFRS 9 we just taught you, and they are also doing that same for. They have done that. This is a very old standard since 2011 or 13. They have done that for this, and even the IFRS 15 I will teach you. They have also done that. I mean, their standards are becoming very similar. So so I mean, we adopted what United States are using. So everything I'm teaching you here is almost the same thing as the United States GAAP. And what the standard wants to do, fair value measurement, is that it's going to be a single point of reference whenever we mention fair value in reporting. That anywhere you see fair value, the way you determine it is now described or prescribed by IFRS 13. So it's IFRS 13 that is the ultimate source of truth when it comes to fair value. However, there are certain standards that are exempted. There are certain standards that are exempted that, okay, you guys take care of your own fair value measurements in your own right. And the very first of which is IFRS 2. You see, IFRS 2 is scoped out from here in the sense that IFRS 2 deals with fair value of share options and shares, if you remember. So it's left to IFRS 2 to determine that. IFRS 13 focuses on fair value of assets and liabilities. So they have scoped out IFRS 2. Let him deal with how he determines its what? Its fair value. Another one is IAS 2. When it comes to net realizable value, because IAS 2 focuses on net realizable value. IAS 2 and even IAS 36, they focus on net realizable value, not just fair value. So they are also scoped out that, okay, you guys determine your own net realizable value in line with your standard. IAS 2, IAS 36, they have been scoped out from this standard. And every other one, we are going to focus or would be applied using IFRS 13. So with that in mind, that this standard came to give us a single framework for determination of fair value, then how does it define fair value now? What is fair value according to this standard? It says that fair value is the price that is received. Fair value is the price that is received to sell an asset or paid to transfer a liability or paid to transfer a liability in an orderly transaction between market participants at the measurement date. Okay, this is the definition given by IFRS 13 for fair value. Said fair value is the price that is received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. Okay. Now, this is a definition you should know, because from this definition, you can determine fair value even with this definition. So let's look at how to determine fair value with this definition by understanding it. So looking at this definition, it said is the price that is received to sell an asset. So when you sell an asset and you receive money, from here we can say that money you received is the what? Is the fair value. That's for asset. For liability, the price you paid to transfer, not to settle, because transfer is bigger than settle. It's not all liability that you settle. There are some that you can just transfer to another party. There are some that they could just discharge for you. There are some that they might just forgive you like that. So to transfer, okay? So whatever price you pay to transfer, not to settle, but what? Transfer a liability. That would be the fair value of that liability. It has to be in an orderly transaction between market participants at the what? At the measurement date. Now, I will focus more on assets because that's the popular area you might find questions in the exam. I would focus more on assets. So I'll be using assets to give you examples to pass the knowledge. So the price that is received to sell an asset, you will see that the first thing you will note here is this. Before we can talk about fair value at all, you have to be exiting the asset or the market, as the case may be. Fair value is an exit price. Is a what? Exit price. It's not an entry price. It has to be exit. It has to be determined from the person that is exiting, that is selling, not the other way around. So from this definition, fair value is first a what? An exit price, both for asset and liability. Exit. The second thing is this: from this definition, in determining fair value from this definition, he said is the price that is received to sell. One has to be very careful, because does that mean that if I could just sell an asset to, let's say, my child, I just say I bring something, would that be a fair value? Okay, so we need to be very careful in such a way that we need to consider that price you are receiving. It must be there has to be market assumptions around it. That would a rational and an independent person pay this money? Would I have received something like this if I don't know this person? So the assumptions that is made in determining this price must be the one that will have been made in the marketplace. Okay, so you need to think about that yourself. That this price, where we would I have, are we going to have received the same price in the marketplace? Would I have allowed it? So market assumptions must be considered. It has to be the same assumption that would be made in the marketplace. And typically, in determining or making these assumptions, you will need, of course, to look at the characteristics of the asset. You need to consider the characteristics of the asset. Because when you are determining the price you received, for it to be fair value, this has to be considered. Because the price you would receive for a new asset or an happening asset should not be the same for the one that is the other way around, an asset that is not new. So we will consider characteristics of the asset. And characteristics of the asset is very important to us, because there are some costs that you might have to incur that you would not even consider. For example, now you want to sell an asset. I said I will focus on assets to be passing the knowledge. You want to sell an asset. You're now involved like a professional, okay, in between, that you need to give that person some money, right? Probably which we call transaction costs in most cases, or probably you need to do a lot of advertising, something like that. You need to incur some costs. So, and let's say the price you now receive is 15 naira. You now incurred, let's say 2 naira. Okay, the price you received was 15 naira. You now incurred two naira. So ultimately, the net was around 48 naira. So the key question is that what will be the fair value, the price that was received? Will it be that 15 naira or the 48 naira? You see, this standard is saying that it's going to be the 15 naira. The reason is that, you see, those costs you incur to facilitate the transaction, to ensure that you sell, we cannot use that as a basis of determining fair value, because they are not objectively determined. The transaction cost for the same asset, you find out that somebody might incur 1 million transaction costs. Another person might not even incur any transaction costs. Another person might even incur so much more, like that. So for that reason, we believe that transaction cost is a characteristics of the transaction. It depends on the nature of the transaction, and it is not characteristics of the what? Of the asset. So our own focus is look at the asset itself. Whatever you understand as characteristics is the asset, the nature of the asset, the type of the asset you're selling. The price you then receive for that is what we call fair value, not the transaction, whatever is now attached to you selling. The only one that we might consider is if you want to transport the asset, for example, now to where you will sell. That one is unavoidable. That one is standard for almost everybody. So to transport the asset to where you will sell, yeah, it's part of the characteristics of this asset. So again, speaking on the price you will receive to sell an asset, we said it has to be an exit price. You must consider market assumptions. It has to be the assumption that will have been made in the marketplace in determining this price. We just want to be sure that you are not biased in determining this price. And of course, characteristics of the asset must be considered, and the location and condition of the assets must also be considered when determining whether the price you receive is the fair value. And the location of the asset, a typical example would be the price you would sell an asset that is located, or a land, even though it's 200 square meters in Banana Island, will not be the same as that you will sell in other areas. Okay? So, and also the condition of the asset also. All of these would ultimately help us determine the price that is received. So, you as an accountant, you need to put in mind all of these, just to be sure that the price you receive is the fair value. Now, another one, before I move to the next one, is that this standard did not specify the type of assets. The standard calls it unit of account, because when you're talking about fair value, it varies depending on the type of assets, whether tangible assets, whether patents, whether financial assets. It depends. So IFRS 13 is just an open standard in determining fair value. It did not specify a particular type of asset, or it did not specify the unit of account. So it is now left to individual standard to address the peculiarity of their assets, or the units, or the unit of account when determining fair value. Okay, that's on the price that you receive. Another one is, this price must be received in a transaction that is orderly transaction. And when we say orderly transaction, we are talking about a transaction where the seller is not desperate to sell, a transaction that is not a forced sale. So for it to be orderly, it has to be a transaction whereby you did marketing, that people are aware of these assets, that a lot of people are negotiating and bargaining prices with you. There was competitive forces, there was competition around these assets. So that is orderly transaction. It is only in such a transaction that we can say yes, that the price you have received is what? Is a fair value. Otherwise, it's not. So it's not all prices that you receive that would be categorized as fair value. The transaction must be in a what? Orderly transaction. You must allow time for marketing activities. Buyers must come and negotiate. There must be competition. The asset must be in the market. It must sit in the market. Is that type of asset that you then sell and collect money that will say, okay, yes, this one is fair value. So in determining fair value from this definition, care has to be taken, because it's not all prices you receive that will qualify as what? As fair value. Another one is, I've mentioned this already, market participant, which is, it must be the assumption that is made between those that have knowledge of these markets in the marketplace, that's market participants, and at the measurement dates. So measurement dates goes to show that fair value today would be different from fair value tomorrow, or fair value yesterday. So fair value is determined with reference to a particular point in time. So we'll say the fair value of at the end of this date, this is the fair value. So when they do fair valuation, they always attach it to a particular day. So it's usually at a what? At a measurement date. Because it will change another day. If you determine fair value on another day, on another time, the fair value would have changed. So this is how we determine fair value, by this definition. But this standard noted that if we want to go this route, it will be very difficult to get fair value. To be frank, looking at making sure, because it's not all prices that you receive that is fair value. You need to consider all of these that I've mentioned for you to determine that, okay, this is fair. So the standard even mentioned it that this is a complex process, but they believe that that is how you determine fair value. So they give us an alternative, um, like a valuation technique. So besides all I've explained, there's another way in measuring fair value. And they call that what? Valuation, valuation techniques in determining fair value. Valuation techniques. So, yes, that's another subheading. So apart from this I've mentioned that can help you determine fair value, there is another way which we believe is more standardized than this one. So, valuation techniques. Number one, there is the income approach. Number two, there is the market approach. And number three, there's what? There's a cost approach. So the one we have seen I can ask regularly is particularly this one. This one I've just explained. Like this thing I've asked here. So I can have not asked it before. But those other exams that I've asked it is they will give you this definition. Know this definition. They will then ask you to discuss how this can help in determining fair value. I've only mentioned how many points here? Just 5 points. So is this explanation that I use to analyze this just to explain how fair value is determined? So it's actually complex because by the time a lot of people might get different answers using this approach. So there is now valuation technique. When you check most financial statements, this is one of these three they use in determining their fair value. So income approach, market approach, and cost approach. So they are very straightforward. Income approach in determining fair value. Income approach. I know you have not seen this before, but from the name income approach, how do you think an income approach can help in determining fair value of an asset? You know, I said I'll focus on asset because that will help drive home the point. How can an income approach help in determining fair value? Yes, please.
Considering the this cash flows as in the incomes that can be generated from that assets, like our asset worth 30 million naira. So now like in 10 years time, these are the income that can generate from this asset. This asset can provide
Let's say you can
subsequent cash
generate 2 million every year.
every year. So
So,
like cash flows for 10 years.
okay.
So now discounting it to the I'm just trying to the present value of today. So to determine our fair value of the asset.
That one is just not try. You know it before. Oh, okay. So that's perfectly correct. Yeah, it's not. It's really not more than that. That's income approach. So you would look at the income the asset can generate. You would estimate, okay, in the next 5 years, in the next 6 years, the next 10 years, depending. At least in practice, it's always minimum of like 5 to 7 years. We want to estimate. Okay, yes, I would do that. Okay, so you would estimate the like the future income you can generate. Then when you now do that future income, you then discount it to present value. So that gives you the fair value. So in summary, this is just similar to your value in use, which we are still going to talk about. So this looks at the present value, the present value of future cash flows. That's the income approach to determining fair value. Is the present value of future cash flows. The second one is this one is no more than that. The second one, which is a market approach. A market approach. So now, what this one looks at in determining your fair value for the market approach is just the selling price of a similar asset, okay, by considering a recent market transaction. So this one, you need to go out of your office to determine this. You have to go to the market and get the selling price of a what? Of a similar asset in a what? In a recent market what? Market transaction. So when you look at a recent market transaction for a similar asset, how much was the asset sold? What did we receive? That is how you determine fair value using the market approach. So can you guess this one? The cost approach. No.
Okay, cost of purchase another attribute replacement cost.
Yeah. That's the current replacement cost. Current replacement cost. That if you were to replace this asset today, how much? If you were to replace this asset, what will it cost in the market? Okay, so these are the valuation techniques. So expect a question like this for like 4 marks or 5 marks, judging from how they have asked it in the past. They will just ask you discuss the valuation technique. 4 marks. Don't start writing thesis, please, because the explanation is not plenty. So income approach is just present value of future. It's not more than that. Market approach is just the selling price of a similar asset in a recent market transaction. Cost approach is the current replacement cost. It's not really more than that.
Current replacement cost. Is it not
The same thing as what?
it's not like the same like
It's
it's
very
using more.
similar. Yes, it's extremely similar. I mean, the only difference might be that this one is considering a very the same assets that, and this one is like an entry, something like that. That this same asset, not a new equivalent of it, but like the same asset with the same condition. If I want to replace it today, how much? So this one is entry, like you want to buy. But this one is exit.
I am thinking that the market approach might not it might be subjective in terms of cost. The
Hmm.
cost another person will incur, you might not know. Though you have an idea of
The
the
price
market price is. But the cost approach it's more like personal. Be able to ascertain every other cost.
is within your control.
Yes.
Okay, yeah, I agree with that to to a large extent. To a large extent, but both of them, the reality is that they are really determined in the marketplace. Okay, even when you want to replace this cost, you are not the one that will dictate the price eventually, right? It's still going to be determined by the marketplace, and fair value generally is not an entity specific determination. Is a market is really a market determination. The only difference between this market approach and this cost approach, this one is entry. You are the one that want to enter the market. This one is an exit. Okay, so exit in the sense that somebody wants to exit the asset. That's the only way we can look at it. Otherwise, they look extremely similar, but you would find out that they might not be the same cost eventually. Current replacement cost, why this is the market, the selling price. Now, another thing is this. When you look at these techniques, for this one now, the input we are using or the data you would need is the future cash flows. I mean, when you look at this one, the data you use is the what? When you look at this one, the data you use is replacement cost. So that takes us to the next thing. So IFRS 13 prioritized the level of inputs you can use. It has prioritized it. So IFRS 13 calls that level of hierarchy. It calls it level of hierarchy. So yes, it will be another subheading. So it has placed a level of importance or a priority over the type of input we expect you to use. So we call that level of what? Level of hierarchy. So there is the level one input. You see, this level one input, IFRS 13 believes that is the most dependable way of determining fair value, that this input is the best. That, in fact, we advise that you use level one input. Since we are giving you a technique, but they don't want to restrict and tell you that don't just use any of this approach. There are type of input that we want you to use. And the one that we encourage you to use is the what? Level one input. And what is this level one input? He said this level one input is unadjusted quoted prices in an active market. He said level one input is what? Unadjusted quoted prices in an active market. That's level one input. And this goes to show that this level one input you can only be determined for an asset where there is a quoted price. That for an identical asset that you want to sell, so you can easily go to an active market. And when we say an active market, it's a market where there is frequency of activities on that asset in that market. There are pricing information there. That and everybody knows how much they sell this asset there. That's an active market. So the price there, you don't have to adjust it. Unadjusted quoted price and active market. For example, now, if you want to know the fair value of the price of, let's say, Dangote Group, for example, now, it's very easy because there is an active market and there is a quoted price there. So when we talk about financial assets, in the area of financial assets generally, it's easy to use level one inputs because there is a quoted price that you don't need to what? Adjust. But unfortunately, it's not all assets or liabilities that you can find an active market for. It's not all. And that is why this level one, the input here is unadjusted quoted price in what? In an active market. Okay, and this is only possible where there is an active market. If there is no active market, there's no way you can know the quoted price, right? Then, if that's not possible, then you can go to level two and level three. Level two and what? And level three. You see, the difference, which I will show you very soon, between level two and level three is what we call observable inputs and unobservable inputs. Observable input is related to level two, which is still good. In fact, IFRS 13 encourages that you should maximize the use of observable inputs and minimize the use of unobservable inputs. So that takes me to what is then observable input. So level two inputs, they call that observable what? So this one relates to The quoted price of a similar asset of a similar asset in an active market. This price will require adjustments. This price will require what? Adjustments. So for level 2, they call that observable inputs. Observable. That you can see. It's still observable. Everybody can verify and see it. So this observable input relates to the quoted price of a similar asset. So you want to get the fair value of, let's say, Glow, for example now. Glow. So Glow, there is no quoted price for it because there is no active market. The guy is not quoted. But you can get a similar asset like MTN, for example now, or Airtel. Those ones are quoted. So the quoted price of a similar asset in an active market, you can use it. But you cannot say that because the share price of MTN is 160 naira. So you now assume that that of Glo 2 is 160. No, they are exposed to different business risk, different financial risk. So they are not so the same, even though they are in the same industry. So you will need to make some what? Some adjustments. You will need to make some adjustments just to allow for, maybe you have to allow for, if MTN is 169 naira, you can say, okay, maybe Glo is 200 naira. Depending on your own assessment, depending on your judgment, depending on how profitable these two entities is, you can pick their financial statement and see, okay, let's make an allowance for this other guy. So level 2 input is good, is okay, is advisable. Ifrs 13 say you should maximize it because quoted price of a similar asset in an active market, but you will need to what? Make adjustments on it. Level 3, they say you should not use it. Is discouraged. Minimize it, except if you don't have a choice. Is if you don't have a choice that you should even get to this point. It's not reliable. It's clear. So when you are disclosing on how you determine your fair value, you need to tell the user which level you are using. If it's level 3, people will know that this one is not so reliable. And why is that? Why is that? Because the standard called this what? Unobservable what? Because nobody is seeing it. Nobody is seeing it because this is the company's internal data. For example, cash flow forecast. For example, is cash flow forecast. So unobservable input is level 3. We don't encourage it because, and it's only if you don't have a choice that you use this. And which of these techniques do you think would use unobservable input? No, unobservable. The income approach. That goes to show that income approach, yes, it is an approach because we believe that there are some assets that you might not be able to get, even a similar asset, for you to know the price. So that's why it's there. But we are saying minimize the use because it's not so reliable. Because you can just estimate anything. You can estimate I believe that we can make 10 billion in the next 1 year, 50 billion like that. Then you now come up with a ridiculous fair value. So we say minimize level three. That is, we don't really like income approach. We don't want it. Okay. So this is, as far as IFRS 13 is concerned, this is how you determine fair value. And really, this is it about IFRS 13. So just one more thing I need to mention. I intentionally left last. So for IFRS 13 now, what we have seen I can ask recently is these two. Okay. But I mean, maybe they are thinking on how they can ask something around this area. But this is one area that we can also use to determine fair value without having to go through these techniques and considering these inputs, looking at the price that is received. But the only thing is that it's not all prices you receive that can qualify as what? Fair value. You need to consider to be sure there is an exit price, market assumptions, characteristics of the asset, location and condition orderly. So what I did not mention that I left last in this aspect is that even that price that you receive, the standard says that it must be in a principal market. It says it must be where? It must be in a principal market. If it is not in a principal market, then exactly. You're not supposed to be in this class. I don't know what you're doing here. It must be in a principal market. So, using this definition, the price must be determined where? And the principal market, the way you determine it theoretically in the exam, is the market where there is the highest volume. The highest volume. So in the exam, they could give you three markets, and they will now give you the volume of transactions. So the one that has the highest volume is the what? Is the principal market. So the price that is received in that market is the what? Is the fair value. The price that is received in that market is the fair value. But so if you are talking about principal market now, for shares, the principal market will be the stock market. Abi? For items like laptops, phones, iPad, where will be the principal market? So depending on the type of asset you are considering, there might be principal market for it. But it's possible that there are certain assets that you won't have a principal market. That there are a lot of places you can buy it. You can decide to go and buy it. I've already mentioned it. Okay, don't worry, I'll write it. Okay, so there are some instances where you might not be able to get like a principal market that you can just buy it from market. You buy it from anywhere. There are a lot of places you can buy it. So which market will now be the market where you can determine the selling price? Then they say that's the standard called the what? The most advantageous market. And this most advantageous market, they said this is the market that maximizes, this is the market that maximizes return on the assets. While this is the market that has the highest volume of activities on the asset. So the most advantageous market is the market that maximizes return on the asset. It's just simply saying that the market or the place where the price you would receive from selling it is the highest. Okay? Of course, you might have to incur some transport costs and all of that. By the time you have deducted all the costs that are relevant, so whatever return that is left the one that maximizes your return, that is the most advantageous market. So this is the market that maximizes return on the assets. Okay, so that is it for fair value measurement, and that is it for IFRS 13. Now, the standard wanted us to know something about non-financial assets. Non-financial assets. Can anybody give me examples of non-financial assets? Yes, goodwill, patents. Ah, you guys are giving me the vibe like non-financial asset is an intangible asset. Yeah, it's not just intangible asset, it could even be tangible assets. So like PP, building, yeah, that all of that, investment property, human being, bawo. So that's a non-financial asset, whether tangible or intangible. Those are non-financial assets. So yes, it is. It's part of it. Okay, so there's something I need you to know about non-financial assets because there was a time they asked you for 2 marks. So you need to just note it. They could ask you for 5 marks again. So for non-financial assets like furniture and fittings, laptop, motor vehicle, goodwill, patents, all of that, they are non-financial assets. So there's something the standard says we should consider when we want to determine their fair value. In addition to all of this, the standard says that when you are determining the fair value of a non-financial asset, you need to consider what is the highest and best use of that asset. The highest and what? The highest and best use of that asset. And from the name, you will know that the highest and best use is the use that is most productive, is the use that gives the maximum benefit on the asset. So it is based on that use that you can estimate a what? A fair value. So that's one. In determining fair value on financial assets, you consider the highest and best use. However, you see, this highest and best use is not just any use that we accept. We only accept a use that is physically possible on the assets. A use that is physically possible for the assets. Sorry. A use that is legally permissible. A use that is legally permissible on the assets, and a use that is financially feasible for the asset. So the highest and best use must be a use that is physically possible. It must be a use that is legally permissible, and it must be a use that is financially feasible. And so when you are considering this, we don't expect you to be ridiculous. It has to be something you know the asset can do physically and characteristically, physically possible for the asset to do. And legally permissible. It must be a use that is legally permissible, that the law accepts that you can use it for. If you want to get the fair value of, let's say a land, and the law says you cannot use this land for residential, but you went ahead to be using it for investment property and all of that, that's not legally permissible. So it must be a use that is legally permissible and financially feasible or profitable. Okay, and that is all for non-financial assets. You can earn you 2 marks, 3, 4, because this is the principle in determining fair value for non-financial. It must be determined based on a use that is the highest and best use, And this use must be physically possible, financially feasible, and legally permissible. Another thing I need you should know, right, that can ask you, which is the last thing, is that you need to be able to confidently talk about why fair value is better than historical cost. Fair value is just like the new way as against what we were using before. As a corporate reporting student, you should be able to conveniently raise like 4 points on why fair value is better. Okay, can we raise 4 points in this class? Why fair value is better than historical costs? Can we raise 4 points?
Fair value shows the like present and actual price considerable for the asset. Like compared to historical cost, that was the past cost, which is a sunk cost. Like cost that asset was acquired a long time ago. But fair value shows us the reality of today's price. What is today's market price of this asset?
I agree with you. I agree with you. So fair value shows the realistic price of these assets as at today, as of now. So, but fair value now, what if they tell you that this is fair value for this asset in 2005? Well, we will not need that today. Anyway, when we're talking about fair value, we are talking about now, today. What's the fair value today? Okay, yeah, it makes sense. That's 1 point. So, fair value gives a realistic value of an asset. Sorry?
Accept technology.
Mm-hmm.
That is in the sense that these days there are changes in technology. As new technologies are coming up, old ones are going. So, and as a result of fair value now takes care of
That's absolutely correct. That's absolutely correct. So, what you have said is that fair value will take care of changes in the technological, the markets, the legal, the business environment, any change. Fair value will help you capture that. Okay, that's correct. Another point.
I would also say fair value also considers like economic and inflative factors to present time. Like how will I say now the cost of acquiring an asset for now relatively to money, value of money might be different.
Fantastic. So fair value consider the time value of money. Okay, it will have considered inflation, it will have considered everything in place. So similar to realistic value, but it's really another point that fair value keeps into account the time value of what? The time value of money. That's three. Right to me. Fantastic. Fantastic. That's also correct. So fair value would help us determine whether you have your investment in an asset has accrued return or not, because it gives you present value, tells you whether you are making a gain or a loss on the asset. That's four. Can we get one more?
So I think fair value helps in decision making because he mentioned some costs which don't use in relevant, it's not relevant to our decision.
Fantastic. You guys are intelligent today. Fair value can help in decision making. Yes, it helps you in decision making. So that's five already. That's very good. So me myself, I don't even have any additional points. Maybe fair value is more relevant than historical costs, right? If you are considering the relevance of them. Okay, good. So I kind of asked this before actually for 4 marks. They can ask it again. There's no reason why they cannot ask it again. Okay, so that is the end of IFRS 13. Let's open our handouts so that we can solve some questions. Samuel.
Sorry, I'm bringing you back.
Yes,
I was
please.
just wondering,
Yeah.
that end part of it which says will require adjustment. Yeah. That adjustment, sir, is there any guide so that it portrays the true and fair value of that, so that people don't take advantage of that.
Okay, so there's a long story around this, so which I won't really tackle it. So for us now, we say that it's a matter of judgment for you. Because there's a lot of work to be done to determine whether you are increasing that price or whether you are decreasing it. So there's no specific way, but it depends on the similar assets. Okay? So which is why it's not a way that will say this is how you should do it. It varies. It depends on the assets because there are some assets you compare to it that your own asset is much better than that. By the time you look at the fundamentals of your asset, like the example I gave you, blue and MTN. So if MTN share is 120 there, so are you going to say the adjustment will increase that of blue to leave me to one side? So it ultimately now narrows down to the fundamentals. It's now left to the judgment of you. But the good thing about IFRS is on the qualitative characteristics. You would have expected that you would have explained in your financials all the adjustments you have made. You would explain it to us so that a knowledgeable user can read it and say, ah, this one makes sense. Like there's something like so there's no standard way of determining. Good question, Samuel. Oh yeah, that's great. Which question should we look at? So in the soft copy I sent to you, let's go to the first question there. In the soft copy I shared with you, let's go to the soft copy to the question under non-financial assets. Let's go to the question under non-financial assets. I've shared the soft copy on IFRS 13 with you. Let's go to the question under non-financial assets. Let's go to the question under non-financial asset. The first question there, the one for market X, page 27.
87.
87, yeah, 87. Are you all there? Come. No, this IS 36. Go to Ifrs 13.
Is there another one?
No, I shared this one before IS. I shared this one before. Yes. Let's come on. So who's going to read first? Who wants to read? There's a question under non-financial assets.
An asset is sold in two active markets, market X and Y, at 58 naira and 57 naira respectively. Wadex does business in both markets and can access the price in those markets for the asset at the measurement date as follows. The price for market X 58 naira and for market Y 57 naira. Transaction cost 4 naira for market X and 3 naira for market Y. Transport costs to transport the assets 4 naira for market X and 2 naira for market Y. What is the fair value?
Okay. If you don't have the question, just listen. It's a very straightforward. It's a very straightforward one. It's a very straightforward one. So if you look at this question, it's an open question. I just want to use it to teach you most of these principles I've explained, right? So they said an asset is sold in two active markets, market X and market Y, at 58 naira and 57 naira respectively. Wandex business, it does business in both markets and can access the price in those markets for these assets at the measurement date. So they gave us the selling price, the transaction costs, and the transport cost. And they asked us to determine the what? The fair value. And that was all. So what I've taught you today is that fair value can only be determined in which market? In the principal market. In this question, they did not tell us which of these markets is the what? Is the principal market. So this they will ask it in the exam like this. I just want to use this to explain some things to you. So so listen, right? So let's assume the principal market is market X. Let's assume the principal market is what? Market X. Then the fair value will simply be the price of 58 naira minus the transport cost of 4 naira. So the fair value will be 54 naira. You will see that I did not deduct transaction cost because transaction cost is a characteristic of the transaction, not a characteristic of the assets. We do not consider transaction costs when we want to determine our what? Our fair value. You don't consider transaction cost. The same thing, if the principal market were to be market Y, the fair value would simply be the selling price of 57 naira minus what? Minus 2 naira. So the fair value will have been what? 55 naira. However, let's assume none of the market is the principal market. That means that we would have used the most advantageous what? Market. And the most advantageous market is the market that maximizes return on the asset. So if I may ask you, Which of these markets is the most advantageous market? Why? Market Y. Why? Higher return. So what was the return in market Y? No? 52. 52. So in determining the most advantageous market, you have to deduct all costs. All what? All costs. So the most advantageous market is market Y because it has the highest return, which is 52 naira, as against 15 naira in market X. Therefore, what is now the fair value if you are using the most advantageous market? Thank you very much. The fair value remains 55 naira, which is 57 naira minus what? Minus 2 naira. Okay, so that's what I want to achieve with this question. I want to teach you. In the exam, they will always tell you, which is the principal market. If they don't tell you, that means you need to determine it using the what? Most advantageous market. And when you are determining the most advantageous market, is the market with the highest return, meaning you will deduct all costs. So you now look at the net return, which is giving the highest. When you have now determined that market, then the next phase is to determine the what? Fair value, which is the price minus transport costs, if any. Do not deduct transaction costs in the exam. Okay, now let's solve another question. Let's solve another question. Okay, this one will be a past question. That was May 2021. Let somebody read this question. Who is reading? Just because you read question 1, so read question 2. May 2021.
A or B? A. Fair value is a market-based measurement, not an entity-specific measurement. It focuses on assets and liabilities and on exit price, that is the selling price. It also takes into account market conditions at the measurement date. In other words, fair value measurement looks at the amount for which the holder of an asset could sell it and the amount which the holder of a liability will have to pay to transfer it required. Discuss the view that fair value is a more relevant measure to use in corporate reporting than historical cost, 4 marks. B. Discuss the valuation techniques in fair value measurement in accordance with IFRS 13, 4 marks.
Okay, let's answer that one first. Is that the first part of this question? Okay. I think why fair value is more important. That's what the exam now will ask you in the exam. They won't ask you why historical cost is more important. No. Is why fair value is more important. So I believe we're able to raise how many points in this class? 5, Abi? And I told you. Why do you want me to write it on the board again? I already dictated it to you. Because we don't have time. Why not go to the next part, which is the B part?
Discuss valuation techniques in the fair value measurement.
Okay, hey, thank God I haven't cleaned that one. So you should write that one too again. So discuss evaluation techniques. Abi, don't start writing unnecessary. The fact that you even mentioned this one alone will have given you like 2.5 marks. Just mentioning 1, 2, 3. So by the time you now explain, is don't say it's just one line now. It should be like 5 lines now. You now start writing that the guy will now not be able to pick the real thing there. Okay? Valuation techniques, income approach. This is a technique to determining fair value using the present value of the what? Future cash flows. Then this one, then this. 4 marks. Then you move to the next one. These are 3 points for you. So what's the next one?
That's the next question.
Oh yeah, let's go to the next question. Did they ask the level of hierarchy? No. Don't put the level of hierarchy. So if they ask this valuation technique, it's just this one. If you want to ask this is another question entirely. They ask level of hierarchy too.
Where is that one?
Oh, that's the next question.
I have not read it now.
We have not read it. Yeah, read it.
Bakatari PLC is a public limited company that is reviewing the fair valuation of its assets in line with the provision of IFRS on fair value measurements. The company has assets that are traded in different markets and is uncertain as to which valuation to use. The assets have to be valued at fair value under International Financial Reporting Standard. Bakatari PLC currently only buys and sells the assets in Market C. The data relating to the assets are set out below. So we have three markets, market A, B, and C. The year to December 2019, volume of the market in units, price per unit, cost of entering the market per unit, transaction cost per unit required. Explain the three-level hierarchy for fair value measurement used in IFRS 13. Discuss with relevant computations how Bakatari should value the above assets under IFRS 13, 4 marks and 6 marks respectively.
Okay, so for the level of hierarchy, you get your 6 marks. Listing 1 1 1 1 1 1 gives you your 6 marks, like that. So level one inputs, unadjusted quoted price in an active market. Okay, if you want to give example, of course you are free, like the share price of shares in a stock market is okay. Then unobservable inputs, which is level two, which is the quoted price of a similar asset in an active market, and this price will require what? Adjustment. You can give example if you wish. That is, if you want to get the price for a financial asset that does not have a quoted price, then we can use like Glow, for example. Now you can use the price of a similar asset, but you need to make some adjustments on that price so that you can arrive at observable. And Samuel asks a very beautiful question that, okay, is there a guide on these adjustments? There's no guide, really. It's a long story because it depends on the assets you are comparing it with. It depends on the. So that's why I mentioned something here that IFRS 13 didn't specify the unit of account. It didn't specify the type of asset you are talking about. So it left individual standards that are applying it. So depending on that type of assets, then tailor whatever guide we have given you here to that. So it depends on the nature that will determine the adjustment you will make ultimately. And level three is unobservable. This is where we will use the company's what? Internal data, like the cash flow forecast of the company. That will earn us 6 marks in the exam. Now, they now gave us that we should also determine what? The, the assets. Okay. So in this question, did they give us markets, stuff like that? They gave us 3 markets. Okay. Which market does the guy operate right now? He operates in market C. I'm sure that market C would be the one that gives him the highest return. Can you check? Can you confirm? Why? So what was the return in market C? 22 minus 5. That's like a 17. Is there any other one? Market A or B doesn't give up to 17 return? Okay. No. I'm not. I'm not solving the question yet. I'm just trying to understand why the guy is operating in market C. Okay, it's because market C. So now let's solve the question. Okay, so you will not use market C, even though you operate in market C, because the questions, the IFRS 13 says that you determine your fair value in the where? In the transfer market. Okay, so you need to explain this because this guy for 4 marks said you should discuss. Abi, discuss. Right. So you said in determining the fair value of these assets, we are going to determine it in the principal market. Okay, However, we can see that Bakatali operates in market C. This is because market C is the most advantageous market, and it makes a maximum return of how much? Of 17 naira. You put it there in that. That's why it's operating there. But for us to determine fair value, it has to be determined where? In the principal market. And you now say that principal market is the market where there is the highest volume of activity. Which market is that? Market A. So market A is the what? Principal market. Therefore, our fair value is the selling price. How much is the selling price in market A? 19 naira. Did they give us transaction cost? You will not consider transaction cost. They gave us cost of entering the market. Are you going to consider that? The only reason why we are considering this is because it's not operating in that market yet. So you have to pay to even have access to that market. It's a compulsory payment and it's standard for every participant in that market. So that is why we are considering it. It's just like transport cost also. Okay? If you were market C, that was a principal market, we will not consider cost of entering the market. We will not. Because he's already in the market. He's already operating in the market. He will not pay that cost of entering anymore. So the only reason why considering this cost of entering is because he is not operating in this market. And how much is it? 2 naira. So the fair value is how much? 17 naira. And that's it for 4 marks. So you will see that I have the solution there in your handout. You will see that for this particular solution, the examiner wants you to discuss. They didn't say calculate. They said discuss with relevant computations, right? So don't just compute and say, you only get 1 out of that 4. You need to explain to us what the principal market is, why the guy is in market C, and determine or specify which is the principal market and support that with relevant computation. That principal market is where you get the fair value, and this is the fair value. Is there any other one attached to that question?
Yes.
Okay, let's read that.
Kantala Limited is a company based in Abeokuta, the Ogun State capital. It uses the revaluation model for its non-current assets. Kantala Limited has several plots of farmland which are unproductive. The company feels that the land would have more value if it were used for residential purposes. There are several potential purchases for the land, but planning permission has not yet been granted by the Abeokuta Planning Authority for use of the land for residential purpose. However, preliminary inquiries with the planning authority seems to indicate that the planning permission may be granted. Additionally, the Ogun State government has recently indicated that some agricultural land should be used for residential purpose. Required. Advise Kantala Limited on how to measure the fair value of the land in its financial statements. 2 marks.
Thank you very much. 2 marks question. I mean, you don't want to spend more than 4 minutes. 4 minutes is too much. Because by the time you multiply the mark by 1.8, that shows you how long you should spend on a particular question. So, given that it's 2 marks, so if you look at the first paragraph of this question, you see that this company is based in Ogun State, and it uses evaluation model, Abi, for its non-current assets. And this non-current asset we are talking about is like a farm. But they say that this farmland it has several plots of farms which are what? Unproductive. It is unproductive. Okay, good. So it has land that is unproductive. Then the second paragraph, they say the company feels that the land would have more value if it were used for residential purposes. So there's a possibility for another use, which is for residential, and they believe it will have more value. Then the third paragraph, he said there are several potential purchasers for the land, but planning permission has not yet been granted by the Abeokuta Planning Authority for use of the land for residential what? Purposes. So the physical planning in that state has not approved them to use it for residential yet. So the next paragraph, he said, however, preliminary inquiries with the planning authorities seems to indicate that the planning permission may be granted. May be granted. Additionally, the Ogun State government has recently indicated that some agricultural land should be used